Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today for our weekly wrap-up. Graham, what can you tell us about what went on in the market over the past week?
Yeah, thank you, Stacy, and thanks for our callers. We just saw a major rally in the markets. Three keys to that. We saw a more dovish Fed, at least in the comments, or it was implied, lower Treasury bond issuance, and some better than expected economic numbers that came in not as hot as expected. So we just saw the U.S. equities have their best weekly performance since March. If we look at the S&P, the Nasdaq, that was up about 5.5 to 6.5%. We saw the Russell 2000 really led that charge of about 7.5%. So we saw the whole market rally. All 11 sectors of the S&P were higher. We did see real estate spike about 8.5%. That sector, discretionary, financials, and communication, all up over 7+%. So U.S. yields did plummet, and that was, I think, the precipice for the market to use as a clue to continue to rally. We did see a loosening labor market. We saw some payroll increases of about 150,000, but that was the smallest gain since January of 21. And the prior 2 months were revised lower, continuing to take that concern about higher rates for longer or rates going up for a lot longer off the plate. So on the inflation front, we saw the average hourly earnings increase were pretty muted, and the Fed left interest rates unchanged. Again, all positives for the concerns about rates being higher for longer, cracking the economy, or pushing us more towards a deeper recession than originally thought. So we did see the service sector slow for the second straight month. We did see the Treasury, as I mentioned before, announce some more modest increase to their auction, which helped with interest rates. But unfortunately, we still saw U.S. home prices up at record highs and affordability at historical lows. If we go overseas, look at Japan, their central bank shifted language to allow for a more flexible yield curve control, which I think helps our bond market, at least our longer dated bonds. Then the Bank of England left interest rates unchanged. Looking at Europe, Germany, inflation cooled pretty noticeably, about 3%. And China still saw some manufacturing activity unexpectedly contracting, possibly giving some concerns about such a slow growth economy over there.
Okay. Well, how will the recent drop in interest rates and the potential end of the interest rate increases that you mentioned affect the economy soon?
Well, I think it takes pressure off of companies that have earnings in the future. So if they have earnings in the future, interest rates are high, they're going higher, that's going to affect, what their financial picture looks like. Companies or industries that have to go out to get loans to run their businesses, that's going to be a less of a cost potentially to them and hurting their profits and revenues. For the average consumer, maybe a good thing here is that inflation is still cooling. Maybe that interest rates for the housing markets don't have to go higher. Maybe they're where they're going to be and start to go lower. So that can take pressure off the consumer's balance sheets on that front.
Okay. And what should investors be considering?
Well, I think the moral of the story of this last week is don't overthink the markets. Don't try to time these markets. Make sure you have a good, solid, diversified portfolio based on your goals, objectives, time horizon, and risk tolerance. And you'll be fine, even though you got to go with the ebb and flow. And it's not always comfortable, but that's what investing is. It's not about being always comfortable. It's about letting time work for you. So all in all, I think what you're seeing is the bond market, as we've mentioned before, is pretty attractive, right? We're looking at the yields pulling back, bond prices really rallying. So I think investors, if they're increasing their duration coming out of these cash equivalents, in these bond areas, can expect higher income and potential capital appreciation. So your total return from a risk-adjusted standpoint could, at least in the shorter term, maybe 6 months, a year, a bit longer than that, could quite possibly be a little more attractive than stocks. But always keep in mind that equities, all in all, if you look at history, have always led the bond market in total return over the long, long time.
Okay. Well, thank you so much for
You
that
got it.
information, Graham. And thanks to our viewers for joining us today. We appreciate you spending your Tuesday morning with us, and we look forward to seeing you again next week on the weekly wrap up. Have a great week.
Take care.